Hey there, everyone. Welcome to my live training, where today I'm going to be discussing 3 key strategies for real estate investors to maximize their tax savings. My name is Jamel, and I'm a CPA with Nelson & Associates, where we specialize in accounting and tax for real estate investors. And in working with real estate investment clients of mine, I'm often asked a common question around the topic of, hey, Jamel, how do I save money on tax through my real estate investments? So I actually decided to conduct this training and memorialize it so that if you're also having the same type of question or struggling with the same question, it could be valuable to you and help you out. So before I actually dive into the conversation, if you have any comments or questions, please feel free to actually leave those in the chat section, and then I'll get back to you as soon as I can. And then with regards to the topic at hand, we're actually going to talk about 3 strategies for real estate investors to actually maximize their tax savings. And really, understanding these 3 strategies is going to be the difference of whether you're able to save tens of thousands of dollars on your taxes or owe that money in tax. And without leaving you in further suspense, I'm actually going to tell you what those strategies are right now, and then we'll get into the detail of them as I continue with the conversation. So the first strategy that you should be mindful of is utilizing the real estate professional status. You're also going to want to be mindful of the opportunity to take advantage of a 1031 exchange. And then next, accelerating your depreciation expense. Now, as I mentioned, before we dive into the details of these strategies, I think it's very important that we first understand that there's a difference between passive income and non-passive income. And this is really important when it comes to your real estate investments, because depending on your classification or category of your real estate investment, it could be the difference of passive or non-passive and prevent you from taking advantage of these strategies. So I think first and foremost, we first got to get the understanding of a passive income versus a non-passive income, and then take it from there. So by definition, passive income refers to income that actually results from rental activity or any other business activity in which the investor does not materially participate. On the other hand, non-passive income, this is income that's going to be along the lines of wages from a W-2 job, anything that you actually generate from an active involvement in business activity, something such as capital gains or an interest income, any investment income like that would be considered non-passive. Now, this is important because as a real estate investor, like I mentioned before, your income is going to either fall in the non-passive or the passive category. And depending on if it's non-passive or passive, you may not be allowed to take advantage of some of these strategies that I'm going to talk and share with you. So another key thing to note before I continue is that your non-passive activity has to be grouped and stays with other non-passive activity. And typically your passive activity is the same situation where you cannot commingle the two. There is exceptions when it comes to commingling, but you have to actually satisfy a few criteria that we're going to discuss. But off the bat, it's important to know that your non-passive activity cannot commingle with your passive activity. And this is important because as a real estate investor, you may have an opportunity where you can, on paper, take paper losses. And those paper losses can result in you recognizing actual losses for a tax year. But if your activity is considered passive, unfortunately, you're not going to be able to recognize those passive losses against your other sources of income, such as a W-2 or business income. And what I want to do right now is give you an example of the passive and non-passive situation. So I'm going to use myself as an example in the scenario of me owning a CPA firm. So the income that I actually derive from my CPA firm would be considered non-passive. And the reason that is because I'm actively involved in the business. I'm actively involved in the day-to-day aspects of operating my business and making my income from the business. So in the eyes of the IRS, my income from my CPA firm is going to be considered non-passive. Now, on the other hand, I actually, in addition to in a CPA firm, I also am an investor and own rental property in which I have existing tenants that pay on a monthly basis. And those rents that I receive and collect from those tenants are actually going to be considered passive income. And the reason that is because I don't actively participate in the generation of that income. It's more of an investment vehicle for me. So in this scenario, if it's a situation in which I have a negative net income or loss on those rental properties, I unfortunately cannot calculate those losses and use those losses to offset my main income from my business activity of the CPA firm. And this is very, very important because oftentimes I come across clients that will calculate losses on their rental properties and be confused about the fact that they oftentimes cannot take those losses to offset against their primary income. However, the reason we're having this conversation is because there is a tax loophole that will actually allow you to take advantage of that passive loss and offsetting it against your non-passive income. And that actually leads us to the first strategy at hand. And that first strategy in terms of maximizing your tax savings as a real estate investor is really going to be along the lines of achieving the real estate professional status. So when I say real estate professional status, if you do qualify as a real estate professional, you can actually take your passive activity or passive losses to offset against your non-passive income. And I oftentimes trip up folks when I say real estate professional status. And the reason that is because you do not actually have to go out and get a degree or get a license or certificate to study as a real estate professional. What this means, rather, is that the IRS has a category in which if you satisfy 3 criteria, then that enables you to be in a position where you can recognize yourself as a real estate professional. And you only need to meet these 3 criteria in order to take advantage of offsetting your passive activity losses against your main primary W-2 or business income. Now, the 3 criteria that you should meet in order to classify yourself as a real estate professional is that you actually have to work at least 750 hours during the year in a trade or business that is considered real estate. The second requirement is that you actually have to spend more than 50% of your time performing in a trade or business that is real estate. So what this means is if you have another job and you're working full-time in this other job that is not related to real estate, chances are you're not working more than 50% of your time in the space of real estate. And then the third requirement is that you actually have to materially participate in the real estate investment. So those are 3 criteria: 750 hours, more than 50% of your time spent in the business of real estate, and material participation. If you satisfy all 3 of these criteria by the IRS standards, then you're allowed to take those passive activity losses to offset against your non-passive income. Sounds great, right? But the issue is most people cannot or will not be able to qualify as a real estate professional based on those requirements. And the reason that is because there's only so much time in the day. And oftentimes folks that are real estate investors are doing it on a passive basis. However, I did mention that there is a loophole. That loophole is to figure out how you can actually qualify for the rep status. And you can actually do so if you do have a situation in which you're working a full-time job or if you have other business activity that consumes your time. And oftentimes I have clients that will be in a situation where they may have a spouse that's a homemaker. And if that spouse is a homemaker and we can actually find a way to qualify them to meet those 3 criteria, then that spouse can then, as a married filing joint person on the married and joint filing tax return, that other spouse that has a W-2 job or a business activity can take the credit of that other spouse as a real estate professional, and thereby reducing the non-passive activity against the passive activity against the non-passive activity. So that is one loophole. And before I get off the topic of the real estate professional status, I will say that there's a few mistakes that I actually see when it comes to individuals classifying themselves as real estate professionals. And these are some common mistakes that you want to be aware of so that you don't find yourself in a situation where you're claiming to be a real estate professional on your tax return and then get a notification from the IRS down the line. So in terms of some common mistakes, I oftentimes get the expectation from some of my clients that it's not as difficult to qualify for a real estate professional status. And the reason is because they think that because of the first two criteria in terms of 750 hours or contributing more than 50% of their time in the space, that they're automatically off the bat going to be a real estate professional. And unfortunately, that's not the case. That's just satisfying two of the three requirements. The most important requirement in this whole scenario is actually going to be the third requirement or criteria, which is you actually have to materially participate in the investment property. So what I mean by this is that if you have an investment property and you are considered to be a real estate professional in reality, meaning you actually are a real estate agent or a broker, and your primary business is to deal in trading, selling real estate property, chances are you're oftentimes going to consider yourself as a real estate professional. But keep in mind, we have to remember what the criteria is for the IRS in terms of tax returns. So oftentimes I will have clients that say, hey, I'm a real estate investor or a professional because I have my real estate license and I practice on a daily basis doing this business. Okay, you check off one box of the criteria. The second box is you have to be in a position where you're spending more than 50% of your time in this particular space or work. And again, if you're a real estate agent or a broker, chances are you're spending more than 50% of your time. So oftentimes where I see some mistakes and issues occurring is folks only stopping at those first two criteria. The issue is you also have to materially participate. So if you're in a situation where you satisfy the first two and you're not actively participating in the activity or the day-to-day activity of that real estate investment, then chances are you're not going to be able to qualify for rep status. And an example of this is a common example that I see happening is a real estate investor will pretty much go out and outsource their rental property to a third-party management team. And effectively, the whole point of that is so that that management team can manage the day-to-day aspect of that rental property, meaning they're dealing with the tenants. They're assisting with creation of tenant rental agreements, collection of those rental agreements. They're assisting with the upkeep of the property, paying vendors, making sure that everything is working smoothly so that the rental property can provide some type of return for you. So if you actually outsource that work and you're paying an individual or a company to do that for you, chances are you are not materially participating in your investment property. And as a result, it's going to pretty much exclude you from representing yourself as a real estate professional on the tax return for the purposes of offsetting your passive losses against your non-passive income. So that's a really important key there. And then there's actually one more thing that I want to bring up when it comes to your real estate professional status. If you own several different investment properties, and let's say, for instance, you own 5 separate investment properties, those 5 individual properties will need to be treated on a case-by-case basis for whether or not you're able to achieve the criteria of those 3 criteria I mentioned. So essentially, if you have 1, 2, 3, 4, 5 properties, you have to go property by property and establish the 750-hour rule, the more than 50% rule, and the material participation rule. If you do not satisfy all of those for all 5 properties, then you're only able to include the passive loss on the activity that you do or on the property that you do meet those 3 criteria. So that's one area that I see trip up some investors, in that they oftentimes qualify for one, and because they qualify for one, they believe that they can qualify for all of their properties as one combined total. And that is not necessarily the case. So that's something to be mindful of. And The key thing here is the material participation criteria. If you satisfy the first two criteria, you now have to double check and make sure that you're meeting the material participation on the third criteria. And if so, you're good to go. Now, with regards to another strategy in which you can actually maximize your tax savings as a real estate investor, I actually like this strategy, and this is one of my favorites, and this is actually utilizing a 1031 exchange. So when you're utilizing the 1031 exchange, essentially what you're doing is you're selling a investment property and you're taking those funds to invest in a separately identified investment property. However, when you sold that first investment property, chances are you possibly or probably may have realized a gain on that sale. And rather than you have to pay taxes on that gain through capital gains tax, the IRS allows you to take those proceeds and use it as either your down payment or acquisition or payment for the acquisition of the separately identified investment property. And this is going to be very, very instrumental in making sure that you can avoid capital gains taxes while still being in a position where you still have some type of cash flow coming in from your investment property. So with the 1031 exchange, it's pretty much a real estate investment tool that allows investors to actually sell an investment property in an exchange of buying another, with the whole goal of deferring capital gains tax indefinitely. And the beauty of this is you can defer indefinitely without an exact timetable in which it ends. And this can essentially go on for the rest of your life. So with this, there's actually a few steps that you need to consider. And I'm not going to get into the detail of those during this particular training, but I will produce another training in which I dive into those details. But the key thing to note here is that this is a second strategy that you can actually use if you're in the market or considering selling an investment property, with the expectation that maybe you want to take those proceeds and purchase another investment property so that you can maintain and continue some type of cash flow from your tenants. Now, let's talk about the third strategy of maximizing your tax savings as a real estate investor. And this is going to be referred to as accelerating your depreciation expense. So everyone knows that's a real estate investor, or everyone should know as a real estate investor, the huge benefit of owning real estate is that you can take depreciation expense of that property to hopefully generate some losses so that you can actually offset those losses against your taxable income. Now, when it comes to accelerated depreciation, this is a strategy that allows for a greater depreciation in the earlier years of your investment property's life. And for a residential property, you typically get 27.5 years to depreciate that property. So if you purchase a property today, you need to figure out how much that property was purchased for in terms of the building value of it, and then you depreciate it over the course of 27.5 years. On a straight line basis, you can take that as a depreciation expense to reduce your taxable income. And this is how you're in a situation where you can now say you have a paper loss on paper, but in actuality, you may have positive income because you still have tenants paying cash flow to you by way of their rental payments. So when it comes to the straight line basis and depreciation, if you're typically going to depreciate over a 27.5 year period, that process can take a pretty long time. And that long time may not be as desirable for someone that needs to identify a greater amount of taxable income to offset, or a greater amount of loss to offset their taxable income. So what that means is you should be considering something along the lines of accelerating your depreciation. And there are some tools and strategies that will allow you to bypass waiting a whole 27.5 years to depreciate your investment property. You can actually depreciate your property as low as 5 to 7 years in some cases. And in doing so, you're able to essentially identify different components of your rental property, such as maybe your appliances, flooring, landscaping, fencing, things like that. And then on an individual level, we identify the value of those things so that we could separately depreciate them over a faster period of time. And when you do this, you're now in a situation where you can actually recognize more loss a lot earlier versus a smaller amount of loss over a longer period of time. And when it comes to this, it is definitely a process that you want to work very closely with a professional or a tax planner, just to make sure that you're understanding the implications of the benefits and the cons. And I say that because I see a couple mistakes when it comes to investors looking to accelerate their depreciation. Oftentimes, they may only be taking the bare minimum depreciation that they're allowed, which is depreciating it over a longer period of time, 27.5 years. In a lot of cases, these individuals are in a position where they can actually speed that up. And it's to their advantage to speed it up because they may have positive taxable income that can't be written off by recognizing these losses as a result. Another issue is perhaps an investor accelerating their depreciation too fast and not being in a position where they can offset those losses against income that they generated elsewhere. So if you're doing that, then you're in a situation where you are not timing your depreciation properly, and you're missing out on the good years that you can actually be offsetting that income against. So that's why I said it's really important to, before taking any initiative or steps in this direction when it comes to accelerating your depreciation, you want to make sure that you're working with a professional and really understanding the pros and the cons and the importance of timing and your income situation. So with that, that actually wraps us up with the top 3 strategies. And as a reminder, we discussed 3 key strategies to maximize tax savings as a real estate investor. And the first one was the real estate professional status. The second was the utilization of 1031 exchanges. And then the last one was accelerating your depreciation expense. I hope you guys enjoyed this discussion today. If you have any questions and would like to connect further on this topic, please leave a comment or a message in the chat box, and I'll be sure to reach out to you. And then